That's right, you're watching Africa Trade and Business, and I'm Bronwyn Seaborn. In this episode, we focus on inflation in Africa, which is at nearly double pre-pandemic levels. And we discuss how the situation can be addressed while still supporting growth. We'll be getting into that with Reggie Mlangeni, Head of Sales and Structuring at Absa Corporate and Investment Banking. But first, your news making headlines across the continent. Africa could suffer a permanent economic hit if tensions splinter the global economy into two opposing trading blocs around the US and China. That's according to the International Monetary Fund. It estimates that sub-Saharan Africa could see a 4% decline in gross domestic product after 10 years under a severe version of this bipolar world. Matters could be made worse if capital flows are also affected, which would do lasting harm to long-term economic development. Sub-Saharan Africa's biggest economies will grow at a slower pace this year. That's according to a Reuters poll. The research shows that dollar strength and critical shortages across the continent have made economic activity cumbersome and added tricky inflation dynamics in key countries like Nigeria and South Africa. The poll pegs Nigeria's growth at 2.7% for 2023 and South Africa's at 0.4%. These two economies make up more than half of the continent's gross domestic product and so substantially impact the region's economic prospects. Nigeria's Securities and Exchange Commission is processing applications for digital exchanges on a trial basis. That's in a bid to widen market participation in the country, where the central bank restricts trading in cryptocurrencies. The SEC is considering permitting tokenized coin offerings on licensed digital exchanges that are backed by assets including equity, debt and property. The move may lure digitally savvy people to local assets, including equities, which have been shunned for years. Inflation in the Democratic Republic of Congo has hit 17%. That's as the country faces increased fiscal pressure from upcoming elections and fighting in the country's east, with the Congolese franc depreciating 13% against the dollar over the past year. But the International Monetary Fund says the country's economic outlook remains favourable, as government is likely to receive strong revenues from mining. And so the fund's staff have recommended that the IMF's board approve another loan disbursement to the DRC of $152.3 million. Standard Chartered no longer intends to finance an oil pipeline in East Africa. The announcement comes as a coalition of climate activists target banks and insurance companies supporting the project known as EACOP. Protesters have warned that the project will threaten local wildlife populations, including lion and hippo habitats, and that it will displace communities and trigger a dangerous spike in emissions. It's estimated that the project will generate 7 times more CO2 emissions each year than the entire country of Uganda. Well, sub-Saharan Africa is facing one of the most challenging economic environments in years, where governments are having to tackle high levels of inflation while supporting growth at a time when the finances of most states are in tatters following the impact of COVID-19. Given this situation, the International Monetary Fund has come out saying that inflation is among Africa's most urgent challenges. And to discuss this in more detail, I'm joined by Reggie Mlangeni, Head of Sales and Structuring at Absa Corporate and Investment Banking. Reggie, thanks for your time today. So in your view, just how worried should Africa be about inflation?
Inflation is an imminent threat to the global financial system, and Africa is not immune to the challenges that inflation poses. The primary source of the challenge around inflation is that in most markets, inflation is usually consumption spending driven. The current market dynamics suggest that for most emerging markets, it's actually imported inflation. The very well documented supply side or supply chain challenges following COVID have meant that there's been a delay to getting basic goods and services. So given the disruption to the ecosystem, which is the financial system, I think the challenges of inflation are going to be very, very severe for the African continent. And I don't think that there's any economy that'll be spared. However, having said that, it does present some opportunities as well, and maybe we can discuss those further as we continue.
We are going to get into those, but like you're highlighting, it's less about local factors that are driving this inflation. It's all about international events almost that are driving inflation. And that's why monetary policy then becomes so important in this scenario, because it's the only thing, or one of the few things, that can be used to tackle inflation. But it's also this delicate balancing act, right? Because too tight on monetary policy and we're going to stifle growth. So if we look very broadly at Africa and we look at the monetary policy moves that are being triggered, how are you measuring the muscle it is being taken to rein in inflation and foster growth at the same time? I must say, I wouldn't want to be a central banker at this point.
It is an extremely tightrope to walk, as you so eloquently put it. The challenge is that the interest rate lever is quite a blunt instrument. And fundamentally, it assumes, precisely what I said in my opening remarks, that the primary driver of inflation is consumption spending. And by increasing interest rates, what most monetary authorities are trying to achieve is to curtail consumption spending by making the cost of borrowing more expensive, and therefore causing industrial players, corporates, municipalities, as well as households to reconsider how they spend or reach their spending decisions. The challenge in this case is, as I said, the bulk of the inflation is imported. So it is almost inevitable that there will be some markets that may end up achieving the extreme effects of too much tightening. And I think that the art and the science for central banks is what should the pace of the tightening cycle be, as opposed to should they tighten or not.
If we think about Africa and living with this elevated inflationary environment, because I think that is something that is being looked at the moment, because policy levers are being triggered, and in some cases it's working, in other cases it's not working, but inflation is here to stay, for at least for the most part. What do you see the second order effects of that being, living in this elevated inflationary environment that we're currently in?
To answer that, I think we need to look at the basket of goods that most African countries trade with the rest of the world. So to take a proxy of East, West, and South, we can look at Nigeria, Ghana, Kenya, Tanzania, and maybe South Africa to represent the South. The themes are the same. The core goods we import from the rest of the world are fuel products, machinery and equipment, and automobiles. So to the extent that we're seeing elevated inflation, those are not the kind of goods we are not going to continue our economic function without importing. The second order effect in this case will be the currencies are likely to depreciate, and we've kind of seen it already. So if you look at when the US started the tightening cycle in March of 2022, the South African rand was trading around 15.50 to the dollar. We're currently at 18, having come down from as high as 20. The same is true for markets like Kenya, which have gone from about 114 to 135, 136 shilling to the dollar, and probably the most adversely affected being the Egyptian pound, which started at around 16 and now is comfortably above 30 to the dollar. And that means that every import item is going to cost the importing country incrementally more. The counter to that is we've found that some of our imported instruments or imported goods are decreasing in price, but we don't see that decrease. For example, if you use Brent crude as a measure of what oil prices should have done, that's come down steadily from comfortably above $100 a barrel to just north of $72, $73 a barrel. Yet what you and I experience at the fuel pump is not the same. That increase in price is purely an indication of how our currency has responded to the inflationary pressures.
Given all of that, it sounds like a very risky environment where there are a lot of risks on the horizon. There's a lot of pitfalls there. Where do the opportunities lie in a situation like this?
I think those risks have always remained. The COVID era created a bit of a bubble, in a sense, where there was perhaps the false sense that some of the risks had abated or had been removed from the system entirely. I think any prudent treasurer or any prudent risk manager is still thinking about debt in a prudent way, is still thinking about investing in a prudent way. From a debt perspective, it probably makes sense to consider a combination of fixed debt solutions and variable debt solutions and shorter term debt, with the view to looking to renegotiate or restructure their debt agreements through time. The same is similar with institutional investors. You're probably going to be looking for more fixed income yield and potentially leveraging the prudential limits to get some offshore investments that can give you a bit of a buffer against any further rand depreciation, and maybe even looking at some passive investments that are referencing a commodity like a precious metal or a base metal, and that can give you some insulation against the uncertainty that we're likely to see in the macroeconomy.
Are we seeing that play out though?
Absolutely. I mean, if you look at the scale of our institutional investor mandates that are moving to more balanced funds as opposed to necessarily looking at pure equities plays, or institutional investor looking for demand for passive returns, which might be an index, and that index could be a foreign currency denominated index, which again gives you the hedge against continued rand depreciation. That theme, I think, is likely to continue into the immediate future.
Reggie, we're unfortunately out of time, so we do have to leave it there. But thank you for joining us here in studio. Reggie Mlangeni is Head of Sales and Structuring at Absa Corporate and Investment Banking. And that's where we leave things for this episode of Africa Trade and Business. From me, Bronwyn Seaborn, and the rest of the team, it's goodbye for now.